I'm on mute. Please unmute. Uh, my friends don't often say that I'm muted, but anyway, uh, we welcome to the Daily Energy Markets podcast. It is Thursday, February the 9th, just gone 10:30 UAE time, and oil trading in Asia. Little change would be the way to describe it, although slightly up in and around $85 on Brent. So big recovery from the where it ended last week. Now Thursday, 4 days into the trading week, closed on Friday below $80. So back up at that mid 80 range. A lot of optimism still on all things China. Let's go to Asia with Valerie Chow, VP head of APAC Asia Pacific for gas and LNG research at Wood Mackenzie. Is this a justified optimism that China's return, its demand, its consumption for energy, oil and gas is moving, accelerating in the direction of $85 on Brent?
Hi, Sean. Thanks for that. So I'm a bit more cautious about China, and I've kind of mentioned this on the show previously. I still see lots of potential hiccups right along the road. The property market remains in quite deep malaise. I think youth unemployment is still pretty high. So our view is that, whilst we do expect, oil and gas demand to increase this year, it's not going to be as bullish as perhaps some of other commenters have been suggesting. And I think a lot of that has to also do with the manufacturing sector in China, right? Clearly, there is a bit of a slowdown globally, not only in the US, but also Europe. And so if the world's not buying stuff, right, by definition, China's manufacturing sector is not going to pick up massively also. So the knock-on impact to that in oil and gas is somewhat muted. I think from a gas standpoint, we think that demand will pick up a little bit. But if you talk about, let's say, incremental import LNG demand, we think that yes, there's maybe a 10% increment this year in terms of imports, maybe going up to 70 million tons by the end of this year. But a lot of that will not necessarily translate into new spot imports, right? So a lot of that volume can actually be catered for by existing ramp up of long-term supply contracts. Bear in mind also that China's obviously been producing a lot more domestic gas, right, in the last few years due to national energy security, and they still have the coal option. They need to fall back on that. So we think kind of the price response, if spot prices maybe fall below $15 per MMBTU, and we're kind of getting pretty close to that. That may trigger some kind of price response, not only in China, but also in Europe. But until we get there, so far demand for spot cargoes has been fairly tepid, I think, in China.
Let's welcome also to the table today Daniel Richards, who is, of course, with the Emirates NBD Bank in Dubai. Daniel, the other big question, there's China, but there's also where exactly is the economic recovery or the economic health of the biggest economy in the world, the US, and the biggest energy consumer? The outlook there was quite bullish and optimistic through January. We saw the financial markets, the equity markets tear ahead. And now with this sort of Fed speak of the last week, it seems some confusion perhaps. But nonetheless, the takeaway from the financial risk markets is, this is bullish for equities because the Fed is done. Your thoughts on the Fed speak over the last week and whether it signals indeed they're done?
Well, I think all of us speak over the last week signals the complete opposite, to be honest. We've had Jerome Powell speaking twice this week. We had Neil Kashkari commenting twice, John Williams, a few other Fed officials. And it seems all the voices, it doesn't seem to be a strong dovish voice out there. Everybody is saying there is more to go and rates will be higher for longer. I mean, the key prompt that's brought this on us over the past week, of course, is that extraordinary jobs print from Friday, 517,000 net gain in new jobs in January. There are questions around that figure given the magnitude of the upside surprise, right? The expectation was around 190,000, I think. And there are issues around population controls and benchmark adjustments. But even if that figure is halved, that is still an extraordinary figure. And when you look at the other data, like the JOLTS numbers, the job opening numbers, the wage growth numbers, nothing there is indicating an economy, as Janet Yellen said, on the brink of a recession. I mean, what that means for Fed does likely mean, as all these officials have been saying, is higher for longer. The next key thing to watch out for, we have initial jobless claims today, but we have on Valentine's Day, we have the CPI prints. Now, CPI has been, disinflation has certainly come. It has been slowing quite markedly, but as Jerome Powell said Tuesday night, a lot of that is being driven by goods inflation. That's inevitable given the normalization of those commodity prices, not least oil, since where we were in the middle of last year, especially. When you look at the other components of a basket, the services and shelter, that isn't slowing to the same degree. Core inflation was still 5.7 last time. So, who's it bearish for? For the US economy? Or if you're looking for a job in the US, maybe it's not so bearish. But if you're investing in interest rate sensitive equities, then obviously it is more bearish. I think we've seen US equities drop off overnight as they took that messaging a bit more to heart. After Tuesday night, they seem to interpret Jerome Powell's messaging as not as aggressively against the exuberance as it might have been. But yesterday, I think there's more of a dose of realism in markets.
Yeah, it is rather, I mean, I don't know, the most concerning part of that data point on Friday, the jobs number, was just how spectacularly wrong all of the forecasting was, which sort of tells you nobody has any idea of what's going on. But what is clear, Ahmed Mehdi, research associate at the Oxford Institute for Energy Studies, is that Syria and Turkey are suffering a very tragic and massive earthquake in which I think only the early indicators are so far of 16,000 that have died, but the probability is that number is a lot larger. Ahmed, if we may be so crass as to sort of look at how has this impacted the energy markets, is this part of the reason why we've seen this upswing in oil prices, the disruption to the Azerbaijan and Iraqi oil getting out to the Ceyhan pipeline?
Good morning, Sean. Not necessarily. I think that the KBT cargoes from the Kurdish Turkey flows are resuming. The storage at Ceyhan has been taking in some of those Kurdish volumes, and likewise, actually, it was a very mild disruption, but naturally, it sort of masks. Certainly for the KRG, there's been some news in the last few weeks about amplifying pressures on their marketing. In particular, we saw the exit of Trafigura, which was a very important player in marketing some of those volumes. And likewise, there's been in the background some issues with regards to ongoing arbitration proceedings between Iraq and Turkey. Realistically, the flat price direction is very much influenced. I mean, what's keeping that sort of prices quite sticky and range bound is ongoing expectations around China reopening, and at the same time trying to understand how Russia disruption will play out, or basically the Russia supply situation as well, alongside obviously what how markets are sort of pricing in the Fed policy as well. So there's a lot going on at the moment.
The situation, Valerie, in China, the sort of reading the tea leaves, as you indicated there, how quickly are we going to see the return? We saw earlier in the week the head of the IEA indicating that China would come back strong. We had our own commentators on earlier in the week saying that oil imports had already increased from 10 to 11 million barrels a day from fourth quarter average 10 to January averaging 11 million barrels of imports. And then we have the data point of yesterday, China passenger car sales slumped almost 40% in January after gaining in December. And even the ever so very popular electric vehicles in China had also fallen 6% in January. Clearly, there's a weak economy here, only crawling out of a COVID trauma. Your own sense of where are we still on this year of two halves? The first half will be a sort of crawl out of the hole, and then the second half will be bumper all the way.
I almost have a naggy feeling, and I hope I'm wrong, but that it might actually be a tale of two halves indeed, but it actually goes the other way. And I think a lot of it is going to be driven by obviously what happens in the US, right, and in Europe. So, I say the whole thing about, the US sneezes, right, the world catches a cold, I think that's the hope, right? And so if we see a systematic decline in economic conditions in the United States, I think that will catch on to the rest of the world, and China is not going to be excluded from that. And so I think that the point around the plummet, right, in new car sales in China is exactly a kind of a warning shot, right, on what's happening. So even in China, despite the reopening, right, and despite the apparent exuberance and kind of in the market, at least in the stock markets, I think that's a bit of a head fake, to be honest. It's a matter of time before the real economic conditions start catching up. I am personally a real bear on the US markets. And I think that will catch on to China. So I think we're seeing maybe the initial stages of that. And I think overall the Chinese consumer, despite the best efforts of the current administration, right, to kind of get consumption to drive the economy, China's, unlike the US, right, and unlike most of the Western countries, it's fundamentally not they're net savers, right? They're not net consumers. And so trying to nudge the country to consume more is going to be difficult, especially when you've got an aging population, right? Dependency ratios are.
But will we not see,
rising.
Valerie, the same thing we saw in the West, in Europe and the US, with this massive amount of savings in the trillions of dollars, which is one of the reasons being attributed to why the US economy continues to move on, even with nearly 5% interest rates, because this massive savings that have been accumulated during the COVID years is also in China, and that's going to come out to play as well and be a driver on the consumer side. You don't see that?
Yeah, personally, I don't. I think from the consumer side, most of them are, a lot of them I suspect are, well, for one thing, amongst, I think it's conspicuous consumption is out the door, right? So the government doesn't want it, right? Billionaires are increasingly a bit nervous about, kind of fronting your wealth, right? The middle class and low income groups, well, they're struggling, right? Jobs are, there's still a pretty healthy job market, but let's say for the youth, for example, youth unemployment is still at kind of record highs at this point in time. So I think there's still, most households, I suspect, are still very cautious in terms of spending at this point in time. I think the other issue I want to point out is also that, traditionally a lot of that savings in China got channeled into property markets or infrastructure development. Like most economies, there's only so much you can take infrastructure development, right? You reach a point where diminishing returns set in, and I think worse in China, the property bubble is well and truly busted now, and that also has implications for local governments, because a lot of local governments, at least, they're short of money now, right? Property prices are down, stamp duty is down. There's not enough money to go around. They spend a boatload of money, right, trying to combat COVID. Ostensibly, some will argue that the reason why they've done a U-turn, right, on the zero COVID policy is because local government has no money, and a lot of COVID testers were not getting paid by local government. So I think that for me, it's going to take a while, right, for China to climb out of the current malaise. And that's not to say never, but it's a process that we need to kind of wind through the economy. And I think to a large extent, also it's conditional, right, on the global economic recovery. And I'm just not seeing that at this point in time.
Daniel, we've seen overnight Disney announcing 7,000 job cuts, even though, as you said, the 500,000 jobs created in January on Friday. We're getting a lot of big headlines around the job cuts in the tech sector over recent weeks. Now we've got Disney cutting 7,000 jobs, and we have overnight also JP Morgan CEO, sort of the dawn of Wall Street, Jamie Dimon, saying that it might be too early to declare victory against inflation. What are the markets seeing that they just don't listen or hear the Fed officials saying more rate hikes for longer? Why is that falling on deaf ears? What are they not hearing, or what are they hearing that's giving them this optimistic push?
Yeah, it's an interesting one, right? Because there's definitely a marked disparity. The market pricing has ticked up a bit over the last week. I think it's back up now 5.1 or so%. So there is maybe a dawning realization that these Fed officials really do mean it. And I think that inflation print, as I mentioned, next week will be key. But, I think they've had a tough time with it over the past 12 months or so, and people are starting to cover their short positions and look for, maybe hoping that things are starting to improve, and it will come. If a cut doesn't come this year, we'll certainly see a pause. If not in March, maybe the next meeting. We are nearing the end of a rate hiking, at least, I'd say, and given the economy underneath it seems to be in pretty good shape, there is a prospect of a soft landing still. Given what we're seeing in terms of the labor market.
But those two can't go together, soft landing and rate cuts.
Well, yeah, I mean, it will come though, right? How do you mean? Sorry, soft landing?
Well, if there's a soft landing of the economy, why would the Fed cut interest rates?
Yeah, but I mean, I don't think they want to necessarily. They'll be happy to have them higher, but a soft landing can still mean coming off those high levels. I don't necessarily think they're going to keep them at that elevated. Even if growth even if growth doesn't contract outright, a weak growth outlook is still something that they might look to support further down the line, I'd expect.
But the point ultimately as to why the markets are not seeing or not listening, I mean, the sense that like the second time round, the Fed chairman this week, after it was a bit like Groundhog Day, coming back and saying more or less the same thing over again. But the point being, this time he had the bumper job numbers. He had the opportunity to sort of recorrect the market with some stronger hawkish language and chose not to do so. Is that my thoughts is that the markets got so used to forward guidance and the Fed holding the hands of Wall Street that this is kind of a divorce. We're not holding your hand anymore. We're not giving you clarity that keeps you comfortable in your bed at night.
Yeah, well, I think that's inevitable when you kind of reach this late stage in the hiking cycle, right? It is going to come down more to each data point. We're obviously, even if the end isn't quite there yet, the indications are that it's not. We're not going to see the same level of rate hikes we saw last year, right? It is going to come down to much more bit by bit, data point by data point, trying to see. I think, as I say, that inflation print next week will be pretty key in that. And if we start to see that core inflation, most stickier, so that was what we was really talking up on Tuesday night as well, that the stickier elements of inflation haven't really slowed down to the degree that they'd want to. But I think that will be a much more month by month kind of outlook from the Fed now. So that kind of forward guidance that we're able to give earlier in the hiking cycle is not so easy, or they're not able to give to the same degree.
Ahmed, we had over the weekend the Saudi energy minister expressing concerns about the news, the ongoing and yet the next layer of sanctions on Russian oil products, perhaps creating shortages in the market. And then Saudi Arabia turned around and rose its OSP, its official selling price, into Asia for the month of March. Your thoughts on those few pieces of the puzzle? What do they tell you about Saudi's outlook? Ahmed, you're on mute.
Sorry, apologies.
Please.
So I think that there's still a sort of wait and see with regards to the products. I think that already with crude last year, the story was actually that we saw redirections. We saw a lot of ton-mile demand increase, and actually now there's a record amount of Russian oil on water, and that's reflecting the longer voyages, and also part of that sort of reshuffle in trade flows. With products, actually cracks this week fell. Actually, diesel cracks in Asia as well fell, and partly as well you can sort of pin that on record amount of stock building from Europe ahead of the ban. Also, gas prices from the warm up from the warmer winter meant that estimates around liquid switching were revised. But also obviously China with what was remarkable in Q4 last year was the diesel yields amongst Chinese refiners massively increased. And obviously with the product export quotas, we've seen clean product exports from China rise. Now, saying that, that's not to say that that's not to say that the products equation is going to mean that Europe won't have a significant challenge. But it's still too early to see. I mean, in my view, personally, I think that there will be an ability, because if you think about it, the price cap that's been proposed is not actually that far off where restricted Russian cargoes are actually trading. So I think that there probably will be another sort of wave of reshuffles going on. In particular, we've already seen shipments from Russia to places like Africa increase. The OSPs, I think, are interesting. I think that generally in the spot market, January was, we saw sort of Unipec very active in the market. The OSPs were increased to $2 for Arab Light. I think it's just about people perhaps needing to understand how the methodology works for the OSPs. It's not just the market structure that's taken into account, but also the refinery gate values and actually because in January the average gas oil cracks were still quite elevated, so it's taking into account some of those grades as well, which basically are diesel rich. If for Europe, the OSPs were probably increased because of the what happened with freight rates as well, so there was a bit of a fall, and that accounted for that increase. But just very quickly, in terms of the point about in terms of what I observed from sort of more physical trades in the market, actually there has been a sort of there's been some pretty good premiums out there, which is sort of reflecting what's happening, even though these are barrels that go into China during perhaps maintenance season. So there was confusion. I don't think it was all down to sort of expectations around robust Chinese demand. I think it was more to do with actually market structure and also what was going on with refining economics.
Well, let's get the survey question in, because I want to close out our last comment round with a sense of where all things Ukraine are going. As President Zelensky tours Europe today and yesterday seeking fighter jets, how would you characterize Russia's war in Ukraine as we approach the first anniversary? Obviously, the Russian framing, which is a special military operation. Is it a regional European conflict? Is it a NATO-Russia proxy war? Is it a global war? Maybe you have some other characterization you have, but of these four, which would you choose? And we'll post that on social media. So I think the answer to this question is going to dictate a lot of where we go this year. So I welcome your thoughts on that question. And Valerie, you get first pop at it to wrap out. What does it mean for Asia? Clearly, the biggest outcome, it seems, for Asia is this incredible discounted energy. Cheapest chips oil into India and China, the two biggest importers in the region. How do you see it going forward for Asia?
Yeah, I think it's obviously dislocated global energy as a whole, certainly oil and gas, but also I think it also extends all the way into coal markets, right, and all kinds of other energy markets. So the ripple effects are going to be long lasting, and they're going to be here with us, for at least the next half decade. And depending on where the whole Russia-EU relationships go, we don't obviously see any gas flows from Russia, pipeline flows, that is, not LNG. LNG is still ongoing. But, as long as those pipeline flows don't continue into Europe, right? We think that there's always going to be a floor on certainly LNG prices, given that there's so little LNG incremental LNG available in the world at this point in time. And it's going to take until at least 2025, 2026 before actually there's more liquidity in the market. So that keeps a floor price on global LNG prices. On the oil side, I think it's an interesting equation because on the one hand, you've actually seen in some ways a rebound, right, in crude oil prices. And that almost kind of makes me think, right, ultimately these prices will feed their way into inflation, right? So at least the Fed is too over complacent and can't think, the battle is won. I'm not sure, because I think these things have a funny way of then feeding back in the economy, right? And I'm thinking back to even 2007, 2008, right, where at a point in time where prices kind of rose very, very quickly in oil markets at a time when the US, let's say, housing markets and everything else in the economy was kind of falling apart. And so you had this almost double whammy coming in 2007, 2008. Now, shades of history perhaps, but I think it's going to be a very bumpy ride going into 2023.
And Daniel, your thoughts? I mean, clearly the conflict in Russia, Russia's war in Ukraine, rather, is has been a big surge in commodity prices last year, which delivered obviously a very big revenue, sort of one-off, you might say, $100 revenue year for the Gulf states. Your thoughts on the outlook for where that intersection point with the fiscal outlook for the region here as a whole, or any other sort of follow through of this conflict into the Middle East?
Yeah, clearly the oil market is the key driver, and we saw budget surpluses rather last year of around 7-8% of GDP, and that's the first surplus since 2014, since prices sold off in 2014 essentially. So that gives the GCC states significant firepower, not only to rebuild their balance sheets and to invest in the long term, which is really what we've been seeing through PIF and the other regional government bodies, but also if growth slacks off this year more than they would like, and we've held a pretty constructive view on growth for a region anyway, which will be driven this year by the non-oil sector as opposed to the oil sector last year. But if it starts to fall off more than they'd like, then they have the wherewithal to boost spending and support economic growth that way. And not only on the oil front, obviously we've also seen a large population expansion here in Dubai, in the UAE, largely on the back of that conflict as well, and related FDI as well. So, in many ways, the GCC and Dubai and UAE in particular have benefited quite strongly from this conflict.
Ahmed, I mean, the big story yesterday was the speech that Zelensky gave in the UK, where you're sitting, and the commitment that the UK, the first major NATO country to commit to supporting fighter jets, or at least fighter jet training. It's kind of like a slight hedge on not exactly fighter jets, but moving into the fighter jet category. We've done tanks, now it's fighter jets. Your thoughts on where this moves forward from an escalation point of view? How do you actually characterize the conflict in terms of the question asked, and where it goes from here? Because from an energy point of view, we had the Total Energy CEO yesterday saying that this sanctions and conflict is creating a very large gray oil market.
Yeah, maybe I'll reserve that point about the sort of military sort of
right
for someone else. But in terms of, I did see that point about the grey market, and I think that's the interesting theme, that you have effectively this. I mean, when you look at, for example, the price cap, the assessment being used for the price cap is actually reflecting the economics of yesterday, in terms of an FOB value for which Russia doesn't actually price its crude into China and India on that basis. It's actually using a delivered pricing mechanism. Naturally, you've seen, and so basically you've got a lot less transparency in terms of where the price discovery is for Urals, which was actually a major price marker for how sour crudes were trading in Europe, and it was used by Middle East exporters to assess how they should price their crude into Europe. So this, I agree 100% with that comment that this grey market is not just about the fact that you've got a sort of two tiers, on products. For example, you've got Russian assessed cargoes and non-Russian assessed, ICE removed Russian origin gas oil from its exchange. So naturally you've got this huge pool of oil, which effectively is OTC outside. It's and actually pricing terms, delivery terms. So trying to get for people like me who sort of spend their days tracking energy pricing, it has become certainly more challenging, but also it's also being reflected across the supply chain, not just in pricing, also in tanker markets where insurance.
Well, apparently what they call the dark fleet, there's over 600 tankers in that fleet. We must leave it there as we've gone past our time. Oil prices on Brent trading a little bit above $85 a barrel. The result of our little survey, which we'll post on social, is NATO-Russia proxy war getting most of the votes. We'll have to see as it evolves over the last 12 months. As I said, is sort of half joking, but very seriously, a year ago, Germany said they'd only send 5,000 helmets. Now we're talking tanks and fighter jets. This is clearly moving in one direction. And as we come out of the winter, I do think the markets are ignoring how big this could become of a factor in determining the outlook in the weeks and months ahead. We'll have to wait and see and hope it's not as bad as it could be. Valerie, thank you so much for joining us from Singapore. Daniel, as always, joining us from Dubai, and Ahmed from lovely, cozy, chilly London, I believe. Hopefully not too chilly. We'll see you all soon at IE Week. We're looking forward to that, coming back to London. And if you haven't had a chance to yet see our very substantial year ahead energy outlook, which some of you guys are in, please, it's all doing the rounds on digital distribution and worth sharing. So please do so. Thanks, everybody. Catch up with you 10:30 UAE time. All the best.
Thank you.
Bye-bye.